Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I am here with your Cabot Weekly Review. I'm recording this on Friday, April 14th, before the market opens. So over the last week, we've received a lot of economic data. I'm not going to jump into that wormhole because once you go down, it's kind of hard to climb out. But bottom line is that the market continues to hold up relatively well because the slowing in the pace of inflation and potentially the near-term pause in interest rate hikes, that's still in the cards, so that's a good thing. As far as the Fed is concerned, the minutes from the latest FOMC meeting were released on Wednesday. The takeaway there is that Fed officials think the regional banking crisis is helping them tighten financial conditions and that maybe they have one more hike to go. Most likely that's going to be just a few weeks in May, when the odds of a 25 basis point hike are just around 69% as of about 8 o'clock a.m. this morning. Back to the stock market. Earnings season just began. Large cap banks started delivering Q1 results. JP Morgan came out. So far, so good there. It'll be interesting to see how those stocks trade throughout the day. In terms of expectations for this earnings season, so across small, mid, and large cap asset classes, earnings estimates have been trending down for several quarters. Not great, but worth pointing out that forward revenue expectations have not really been coming down. The implication there is that, broadly speaking, profit margins are going to take a hit in 2023. In other words, corporate revenue may be near record highs, but companies are going to make less per dollar of revenue than they did last year. Again, we're talking at a market level index here, or market index level. Rising costs, softening demand, obviously not exactly a great mix, especially when interest rates are still going up and recession odds are rising. Of course, we still have some risk of financial contagion from the small and regional banks. That can all sound pretty dire if you're a glass half empty type of person. But, of course, the stock market tends to look forward about a year, and we could be in much better shape just heading into the back half of 2023, especially if we have this current recession, this rolling recession, which rolls on through without snowballing into a full-blown hard landing recession type scenario. So, I guess let's go back to earnings season. So if we look at large cap earnings, this was at the beginning of this week. Forward estimates saw large cap earnings falling about 6 to 8% in the first two quarters. But in the third and fourth quarter of the year, earnings per share is seen rising by about 1.5% to 9.7%. So for large caps, the earning picture is, kind of bad to better. For small caps, EPS was seen down 12 to 17% in the first half of the year. No doubt the high weight of economically sensitive stocks, we're talking financials, industrials, materials, energy, all those in the small cap index have definitely hurt earnings expectations since SVB's demise. But again, in the back half of the year, third and fourth quarter, earnings per share for small caps begins to improve, looking at around negative 3.3% EPS growth in Q3 and then positive 8.7% in the fourth quarter. Kind of like large caps, same sort of trend, bad to better. But this not so great, but maybe better news later expectation, I think is kind of why the market continues to hold up. If we look at what the yield curve is doing, we'll go to that. It's been kind of interesting to watch this. So obviously, as you can see here, this is the 10-year note, the yield 3.45%. The yield on both the 10-year and the 2-year Treasury have fallen lately, even though the target Fed funds rate has gone up. The message is that the market sees a higher chance of a mild recession and possibly the Fed being done, just about done with the rate hikes. So Wednesday's FOMC meeting minutes support both of those scenarios. My question is, why would the Fed keep hiking rates if they project a mild recession in the back half of the year? It seems a little silly to me. I can understand one more hike in May, but if we get a hike in June, I think I might lose my mind, and I think the stock market would not like that either. All right, back to the market. So as we can see here in the S&P 500, we're kind of bumping up against that overhead resistance from February. Be interesting to see if earnings season can help us punch through that. I kind of think that this bad to better thesis for inflation and the economy has merit, especially after what we've heard over the last week. And I think the takeaway for investors is that, we need to continue to tread carefully, but position for better times ahead. Yields seem to be coming down, which should offer some support for the stock market, provided that we don't tilt too hard into that hard landing camp. So coming up later today, some more economic data. It's Friday, of course, retail sales, industrial production. I'm recording this video before that data came out, before that data comes out. So we'll just, we'll see how that goes later in the day. All right, let's get into stocks. So a lot going on. I think, kind of high level, big picture, what I have noticed is some of these mega cap stocks, just like these widely followed, widely owned stocks, have definitely shaped up. So we have Apple here looking pretty good. Microsoft certainly has come up and, like Apple, looks pretty solid. Amazon, not as good, but certainly better. And then Disney, kind of like Amazon, has come up. Not great yet. Netflix. Coming up, 345, 380 is where the overhead resistance there would be. But also, MasterCard and Visa, again, just going quickly through some of these widely owned stocks that I tend to follow. They don't look bad. And Thermo Fisher shaping up a little bit. So I think that, the upward momentum in a lot of these stocks is helping investors kind of feel a little bit more positive about the state of the market. Also, as far as some ETFs go, kind of growthy ETFs, the MedTech medical device ETF from iShares, the IHI here, has been on a nice uptrend for a couple of weeks. At 55.34, it's coming up against overhead resistance at 56. So it'll be interesting to see if we can have the IHI punch through. And this last week, some news in biotech kind of helped the IBB, the iShares Biotech ETF, get rolling again through its 50-day moving average line here. So in terms of individual stocks, kind of have a list here, I think 6 or 7 names that I think are worth keeping an eye on. First up, this week we heard from JMP Securities on Shopify. So they upgraded the stock earlier in the week. They put a $65 price tag on it. Stock is trading around $45 right now. That led to a nice bump here on, I guess this was Wednesday. Stock gave that back up, but kind of interesting to see a name like that that's been so beaten down, maybe trying to, make another run up into the 50s. They just talked about, the note talked about how Shopify is still in investment mode, but there might be upside potential to revenue and profitability estimates. Another stock here is INMD. So this is a small cap med tech company, market cap of $3 billion. It jumped on Wednesday when the company came out and pre-released Q1 earnings, came in about 5.5% ahead of expectations on revenue and about 10% ahead on adjusted earnings per share. Question here is this going to have any momentum and get INMD to break above this trading range of 40 to 42 that has kind of served as overhead resistance for 6+ months, but continued strong performance from INMD. Flywire is another name that kind of popped up again. So the stock just moved above its previous trading range. I mean, very slight move yesterday to get above like that 29 area. So it's about $30 right now. Goldman Sachs increased its price target on Flywire on Wednesday from 30 to 34. So keep an eye on that one. Earnings should be coming up in the first 10 days of May. Another small cap name that not widely followed, HURN Consulting, $1.6 billion market cap, has come up against overhead resistance around 82, 87, and then yesterday moved through that. So keep an eye on HURN, seeing if it can continue to move higher. After this big move here on the Q4 report, thought that HURN could really take off, but it gave some of that back, but might have just been some short-term profit taking because the stock has definitely shaped up in the last couple of weeks. This week also have seen a decent amount of interest in Iveric Bio. Ticker symbol here is ISEE. Market cap is just under 4 billion. So a few catalysts coming up here. Obviously the stock chart looks pretty good, moved ahead of resistance in that 25 area this week. So we have, it's a biotech, so there's a trial data that's coming out, going to be reviewed at the annual ARVO meeting from April 23rd to 27th. So that'll start in a couple of weeks. And then the bigger potential catalyst is a PDUFA date on August 19th. So check out Iveric Bio if you're interested in seeing what's going on with its trials and that data, because I think the stock's going to move considerably one way or the other depending on the data. We have also seen Pinterest shape up a little bit. So I have this green line here kind of marked just above 29, trying to see if we can get Pinterest to break out above that. So interestingly, like this last week, we got Sensor Tower data for March, which kind of tracks data among social media companies. Pinterest has the highest US user growth among the group, about 8%. YouTube was flat and most other platforms shrunk. Internationally, Pinterest was second behind Snap. It grew users by 10% internationally. And time spent on Pinterest in the US was also the highest among the group at 24%. So if you dig into those details, the takeaway really is that Pinterest is doing well, especially relative to peers. Might be why this stock continues to shape up, although it's, it's generally trending upward, as you can see with the 50-day line, but in a pretty significant range. So sort of have to have some faith in the story out a few quarters in order to hold on to this one. Last but not least is Shockwave. Ticker symbol here is SWAV. Market cap just under 10 billion. This is another med tech company, and the stock jumped on what I guess it's Tuesday. What happened is that Monday the CMS released new reimbursement rates for inpatient coronary procedures. Bottom line is it looks like Shockwave may enjoy around a $4,000 benefit on some procedures as a result. Kind of have to dig into those details to really understand how that's going to affect revenue, but obviously $4,000 more per procedure, certainly big news, and that has helped the stock jump above its 200-day moving average line. All right, guys, there's a handful of stocks I think look pretty interesting, especially if economic data can continue to come in and the Fed can ease off a little bit after May. That's it for this week. Have a nice weekend, and we will see you again soon. Take care.